The American retail landscape is undergoing a seismic shift, and some of the most iconic fashion brands that once dominated shopping malls across the nation are now teetering on the edge of financial collapse. Today, we're diving deep into 15 American fashion brands that are facing serious financial troubles and potential bankruptcy in 2025, examining the factors that led to their decline and what this means for the future of retail. Let's start with Gap Inc., a company that's been struggling for years. Once the epitome of casual American style, Gap has seen its market share steadily decline. The company's stock has plummeted 70% in the past 3 years, and they've closed hundreds of stores nationwide. Their attempt to remain relevant through collaborations with celebrities like Kanye West backfired spectacularly, and their core customer base has largely migrated to fast fashion retailers and online platforms. Express, another mall staple, is in even dire straits. They've recently announced the closure of 150 stores and laid off 10% of their corporate workforce. Their attempt to pivot to a more modern, digital-first approach came too late, and their debt has ballooned to over $280 million. Industry analysts predict they might file for Chapter 11 bankruptcy protection by the end of 2025 if their current restructuring efforts fail. Abercrombie Fitch, despite a brief resurgence in 2022, is facing serious headwinds. While they've attempted to shed their controversial image from the 2000s, their sales have continued to decline. The company's expensive retail locations and failure to capture the Gen Z market have left them vulnerable. Their latest quarterly report shows a 15% decline in same-store sales, and their cash reserves are dwindling rapidly. J.Crew, which already went through bankruptcy in 2020, is struggling again. Their premium pricing strategy isn't resonating with inflation-conscious consumers, and their product quality has been criticized. The company's debt restructuring from their previous bankruptcy hasn't solved their fundamental problems, and they're now facing a second potential filing, Victoria's Secret. Once the undisputed leader in intimate apparel has seen its market value drop by 60% since spinning off from L Brands, their late attempt to rebrand with more inclusive marketing hasn't translated into sales, and they're losing market share to newer, more authentic brands like Savage X Fenty and Third Love. Their expensive mall locations have become a liability rather than an asset. American Eagle Outfitters is another brand showing warning signs. While their Aerie subdivision has performed well, the main brand is struggling with inventory issues and declining margins. They've closed 200 locations in the past 2 years, and their debt-to-equity ratio is concerning investors. Chico's FS, which operates Chico's White House Black Market, and Soma, is facing significant challenges. Their target demographic of middle-aged women has shifted shopping habits dramatically post-pandemic, and the company hasn't successfully adapted to online retail. Their recent acquisition by private equity firms has added substantial debt to their balance sheet. Forever 21, despite emerging from bankruptcy in 2020, is still struggling to find its footing. Their fast fashion model is being challenged by even faster online competitors like Shein and ASOS. The company's attempts to maintain relevance through collaborations and digital initiatives haven't generated enough revenue to offset their operational costs. Guess has seen its market share erode consistently over the past 5 years. Their premium positioning is being squeezed from both ends. Luxury consumers are choosing higher-end brands, while their core customers are trading down to more affordable options. Their international expansion hasn't delivered the expected results, and their debt levels are becoming unsustainable. Men's Warehouse parent company Tailored Brands continues to struggle with the shift away from formal office wear. Despite emerging from bankruptcy in 2020, they're facing another potential filing as corporate dress codes become increasingly casual and wedding-related sales haven't recovered to pre-pandemic levels. Ann Taylor's parent company, Ascena Retail Group, which already went through bankruptcy, is showing signs of distress again. Their attempt to position themselves as a modern workwear brand hasn't resonated with younger professionals who prefer more casual and versatile clothing options. Francesca's, the boutique-style retailer, is struggling to maintain relevance in an increasingly digital retail landscape. Their merchandise mix, which once set them apart, now seems dated compared to online boutiques that can quickly adapt to trending styles. Their small format stores, once considered an advantage, have become a liability due to high operating costs. Destination XL, the largest specialty retailer of big and tall men's apparel, is facing increasing competition from mainstream retailers expanding their size ranges and online-only competitors. Their high operational costs and limited digital presence have put them at a significant disadvantage. New York & Company's parent company, RTW Retail Wins, has been unable to effectively compete in the modern retail landscape. Their attempts to rebrand and focus on workwear haven't generated enough sales to offset their operational costs and debt obligations. Finally, BCBG Max Azria, despite previous restructuring efforts, continues to struggle with relevance and profitability. Their premium positioning has been eroded by contemporary brands with stronger digital presence and more modern marketing approaches. The common threads among these struggling brands are clear: high operational costs from extensive physical retail presence, slow adaptation to digital commerce, failure to connect with younger consumers, and substantial debt burdens. The pandemic accelerated many of these issues, but the root causes were present long before COVID-19. What's particularly concerning is that many of these brands have already gone through bankruptcy or restructuring processes, yet haven't addressed their fundamental problems. The retail landscape has changed permanently, with consumers expecting seamless digital experiences, sustainable practices, and authentic brand messaging. The future for these brands likely involves significant downsizing, digital transformation, or potential liquidation. Some might be acquired by larger companies or investment firms, while others might disappear entirely. This retail apocalypse isn't just about changing consumer preferences, it's about the fundamental transformation of how Americans shop and what they value in fashion brands. For employees, suppliers, and shareholders of these companies, the coming months will be crucial. Many of these brands are implementing last-ditch efforts to avoid bankruptcy, including aggressive cost-cutting measures, store closures, and attempts to renegotiate debt terms. However, without significant changes to their business models and customer engagement strategies, these efforts might only delay the inevitable. The demise of these once mighty retail brands serves as a cautionary tale for the entire industry. Success in today's retail environment requires agility, digital sophistication, and a deep understanding of changing consumer values. The brands that survive will be those that can adapt quickly while maintaining financial stability, a challenging balance that these 15 companies have thus far failed to achieve.